Hello.
Hey, Chuck. The Patty and Denise, hello.
Can you hear me okay there, Henry?
I can hear you loud and clear.
All righty.
And I can hear you both, so that's good. I think everybody else can probably hear you too.
Yeah.
Awesome.
Looks like you're in your office.
I am, yes. Yeah, with the door closed. Otherwise, the dog will be in here in a minute.
Oh, I want to see your dog.
Yeah, I know. He'll be up here on the table. All right, well, I'm going to mute myself so you can do your thing there, Henry.
Me too.
Hey, James.
Hey, where my let me think I'm on the wrong account. Be right back.
Hi, Ranjit. How are you?
I'm good, and you?
Doing all right. Doing all right. Oh, your evening's going well?
So far, so good. Yeah, still working.
I know. What time zone are you in? Where are you in?
Central Dallas.
Oh, so you survived the cold. Now is it really warm and sunny now?
Oh yeah, I mean, we don't even realize that 2 weeks back was so bad. Things changed like day and night.
Yeah.
Like a 180-degree turn there.
So you didn't lose power for too long.
Oh yeah.
Yeah, you don't know how precious is heat and electricity is until you
I
don't
know,
get
I
any.
know. Yeah, I mean, electricity stops and life stops.
Man, was like, James is back to the wild.
Yeah, I use my account for work, so I had to switch settings and things. So yeah.
No worries.
Is that Yosemite in the background there, James?
It is.
I recognize the
part of
granite.
California. Proud of that.
Yeah, that's the river. You rafted down that river?
No, we were on a bridge, just taking a picture.
Oh,
yeah,
nice.
taking in the beauty.
Yeah. Love that place.
How are you doing, Patrick?
Doing good.
All right. So where are you at?
Northern California, San Francisco Bay Area.
Ah, Bay Area. Awesome. We definitely have a lot of Californians here on this call.
Very true.
Awesome.
Warmer
hey-
too.
I know. Yeah. Hi, Deepa. How you doing?
Yeah, it's a big state.
Hey, pretty good. I am trying to turn on my camera. For some reason, it's not working. But just to introduce myself, I think this is my first time attending this type of a webinar with you guys. And I also live in Bay Area. And yes, the warm weather cannot beat it.
So you guys have to pay the Californian tax, sunny tax. Is that what it's called?
Yes. Oh, yes.
Yeah. All right. I think we're still waiting for our guest. Hey, Jimmy, can you maybe text?
Yeah,
Jack?
he's connecting his audio right now.
Oh, okay.
Yeah,
Oh, there
he's in
he
the
is.
room.
All right. And it's Mr. Comas here. Haven't seen you for a long time. How are things going?
It's going really well. How are you guys doing? Congrats on getting such a spectacular guest. I saw the invite. I thought I had to come.
That's right.
Yeah,
Heavyweight.
once in a lifetime.
Pretty much. I have a buddy that did a deal with him, and or I believe he did a deal with him. But he's he comes. He's notorious in a good way. He's got so.
Mhm. Henry, are we live on Facebook?
Oh, you want to do it? Oh, sure. Let me.
Well, no, there were a few registrants on Facebook, so just don't want to leave anybody out.
Yeah.
Thanks.
Well, once Jack is on, why don't you kind of kick us off? Is that all right?
Sure. Yeah, I think his audio is connected, so I think we can go ahead and get started. Jack, well, just to confirm, Jack, are you here on the line with us?
I think he's on.
All
mute.
right. Can you hear me
Nope.
now? Is it better
Yeah, there we
Yeah.
go? All right. Awesome. Thanks.
go. Hey, Jack.
Yes.
Hey.
Hey, how's it going?
Yeah, it's been a while.
Good to
Yes.
see you.
Time flies, huh?
For
Sorry
sure.
for being a little late. My apologies.
Oh, no worries. I know it's a little late for everybody, actually. So just kind of how
Yeah.
the schedule is aligned this time, because I appreciate everyone, taking time out of your day to come to our webinar. And I guess with that, I'll just go ahead and kick it off. But for everybody or anybody who is new to this kind of series of webinars we do, we're part of the Coast-to-Coast Facebook group, and we interview guests. We have educational webinars ranging from kind of beginner basics to how to underwrite properties, mostly multifamily. We've had what we call co-investing webinars, where we take a deal that is kind of circulating through the community, and we underwrite it together and kind of really bunch heads together and kind of see, like, if we were investing, and sometimes we do, into a deal, and how can we kind of learn from each other and to make the best investment decisions. And we always have a blast doing that. So we'll probably be doing one of those, maybe even this month or next month, actually. So because we're kind of haven't done one of those in a while. For our special guest today, we wanted to do an interview. This has been something we've wanted to do for, I think, Jack, I initially approached you about it back in sometime in the fall, but as anyone who knows Jack, he's doing deals left and right like a poker dealer. So it's really hard to nail down a time for him. So, but I'm glad, we have the time today. And we have a few questions we want to kind of just have a chat. And this format's not really like a lecture per se, but it's more of like an interview and a dialogue and discussion, and just try to learn and share as is common throughout the multifamily community. And it really is a time to just get to know each other and network and share value. And then I think Henry will have a dedicated networking section at the end, if I'm not mistaken. So yeah, there'll be plenty of time. But like I said, I do have a few questions. But if anyone on the call does have specific questions, please do not hesitate to ask questions. Jack is a very open person, at least from what I know of him. So
Yes.
And I'm sure Jack can probably learn a thing or two from us. So you never know. So
we always learn from each other.
Yeah, absolutely. So but yeah, just again, welcome everybody. This is Jack. If anyone's just joined, we're having a lively discussion with Jack Aduwo, multifamily veteran. So but Jack, for anyone who doesn't know you, which may be hard to believe, but if you could share kind of a brief timeline or even history of your background and kind of like what you do today, and kind of like who is Jack Aduwo?
Right. All right. So guys, thank you so much. Thanks, James. Thanks, Coast-to-Coast team, for the opportunity to, just come and hang out with you guys tonight, talk about real estate, which I really enjoy talking about, and everything related to that. So I'm Jack Aduwo. I am based in Idaho, Boise, Idaho. As a matter of fact, I used to live in Boise and moved to Utah, and then I just came back to Boise December, so about 2 months ago, give or take. And I love it out here. I've been doing real estate since 2009. I started with single family. Kind of Boise is my roots in terms of where I started my real estate career. Started with single family investment here in Boise. I still own all my single families. I self-manage them. I run them because I just think it's most cost efficient to run them on my own. But over the last 5 years, I've been kind of basically focused on multifamily investments. That's been basically my primary focus. I've not bought single family over the last 5 years. My multifamily investment, basically, I've been primarily in the state of Texas and Arizona that I've done investment in. I'm looking for more properties in Atlanta or Georgia and Florida. My goal is to at least get 1 or 2 deals in both markets this year. I have a very aggressive plan for this year that I think I'll be able to achieve, or at least close to achieve by end of the year. Right now, my multifamily investment, the smallest apartment I have is 132 units. The biggest I have is 236 units, so that's the largest I have. So basically, it's span in between those. The oldest apartment I have is 1971. The newest I have is 2009. So basically, span between different. I'm primarily focusing on B plus or A class assets, just because I can get the same return while focusing on new assets. I love Texas. It's been really good to me. I feel like that's my bread and butter in terms of just opportunities that come out of that market. I can get similar assets for way better price compared to other markets. So that's kind of high level about me. I'm not sure if I touch everything, but of course, this is just the beginning. So as we go along, I'll be able to explain more and discuss more about myself and other things about what I've done.
Yeah, it's quite a journey that's still in progress. Yeah. So
yeah. By the way, I'm just gonna get James. Are you hearing noise in the background? Because I know I have kids. I have 8, 6, and 3-year-old, and they're having a blast room next door. So in case you hear too much background sound, please let me know. I can have them go to a different room to play.
Yeah, I think your microphone's fairly directional, so it's not. Okay. Yeah, we can hear you pretty clearly. So.
Okay, good. Good.
But yeah, I did want to kind of talk about because you and I talked a little bit about this in the past, but the beginning of your investment journey, you started in single families, which there a lot of people do, but they never really make that jump to multifamily. So what was their catalyst to make that jump? Because while they are still sort of residential real estate, it is it's a different industry. It's commercial, new lending terms, new ways of dealing with brokers. It's not necessarily a thing you can do wholly by yourself, at least effectively. So like what was like, I'm a single family investor and now I'm a multifamily. Like what was involved in that switch for you?
So the way I got into single family, me and my wife, we just got married in 2009, and we moved to Idaho, and we bought our first single family, right? And then we found out that we had some money on the side that we could use to buy other single family. So we started buying. We're basically buying a house on average every quarter, because back then Idaho was still selling pennies on the dollars. Good luck finding the same house for the same price right now. It has really changed. But when we bought 10 houses, we could not find any more good deal with a good loan. I mean, the house. Well, I think about. The good deals were still there, but we could not find any loan because, back then when this is like over 5 years ago, the moment you reach 10 houses, your loans are no longer Fannie and Freddie government-backed loans. So in other words, anybody who's giving you loan is on their own portfolio. They can't stand around and, sell it to Fannie or Freddie. And so we basically, were cornered in the sense that we could not find any good loans after 10 houses. We basically, anybody who was willing to lend to us were demanding crazy, making crazy requests. For example, I remember one of the, lenders we were talking to wanted me to put, deposit, 12-month deposit for all my houses, all my 10 houses, for 12 months. They're basically assuming that all my houses will be vacant for 12 months straight. So I have to have a cash reserve to cover mortgage payment for all the houses for 12 months straight. It's kind of ridiculous. I mean, seriously. And then in addition to that, their interest rate was like 200 basis points above the going rate. And I had to put I think 30 or 35%. Something crazy down payment, and so just couldn't get any more loans. So I started researching into other types of, financing. Then I started here that apartment, you get different kind of financing. That with apartment, they finance based on the performance of the apartment, not necessarily based on your credit or what you have in your bank, And so I started looking into that, and that basically what, put me into the multi-family space because I couldn't find any good loan in the single family space. And the only place where therefore that I could find any reasonable loan was in the apartment. And, I remember talking to one person, and I remember I was looking at, I think, 4-plex, 8-plex, something like that. And they were like, oh, we only give loan for at least $750K, which was like shocking. I'm like, wow, I never knew a lender can give a loan whereby the minimum requirement is that the loan amount has to be at least $750K. And of course, went online, started researching and, investigating and learning. And then that's when I found about, the Freddie and Fannie, how they underwrite, their loan amount requirement and all that stuff. And then, the world just opened up like, wait a minute. So I can now get a loan, buy a big asset, pay less down. Because at that time, my thinking was, oh man, I need to now start planning on putting 30% down, 35% down, and I have to have 6 months, 8 months, 12 months of, reserve requirement for my other properties. And I felt like I can buy, a 20-unit apartment for the same price, same amount of money I could buy, my single family, except that I don't have to put all those crazy, meet all those crazy demands, and then just open up my eyes. And so after that, I just started focusing on multifamily. There's a number of real estate places you can learn about multifamily. I remember one of the ones I started looking way early in the game was Michael Blank. Ran into him. That's where I learned the idea of syndication. He was the first person I had the idea of syndication from, and just Google did all the online research, to see what I can do and learn as much as I can. So that's basically what brought me into multifamily, simply because I couldn't find any more reasonable loan. I could find loan, but none of them were reasonable in single family space. And basically, with online research, found that I can find better loan, with less requirement and get way better, bigger products in the multifamily space.
Yeah, that's very. Yeah, it's very interesting. I haven't really heard that too often about the kind of the lending side being the driver behind things. But I have heard depending on where you are in the economic cycle, you can either have great deals with poor lending terms or poor deals and great lending terms. So it's kind of like a yin yang there. So, but that's interesting. Yeah, and I think we're kind of seeing that a little bit today. My opinion, the lending, the rates are getting a little bit higher, but back a few months ago, it was just like I saw, I think a deal that had like a three something rate on it for a Fannie Mae or one of the agency. I forgot which one, but yeah, it was just crazy. So
no doubt.
Yeah. And when you did those first investments, were you still kind of like, I'm staying in Idaho and Utah, or did you kind of just from the get-go go out of state? And if you did, what would...
No, actually not. So initially I was focusing on fourplex in Idaho, and then I spent fourplex in Utah and Idaho, because by the time I was switching to multifamily, I was actually living in Utah. So I was only focusing on, fourplex in Utah and Idaho. And then I started looking into, sixplex, they went to 10plex. Of course, at that time I was still spoiled with the kind of returns I was getting on single family. I mean, I was getting 2%, return. And as as a rule of thumb, you can get 2% return on a monthly basis. That's a really, really good return, for a single family. But, I couldn't find anything, so I gave up on Utah and Idaho, went to Arizona, couldn't find anything, then went to Ohio. And Ohio is one place that I really got close to getting my first deal. I remember finding this 52-unit deal that was selling for about, $2 million, give or take. And I lost that deal. I didn't lose it because the numbers were not working, but I lost it because at that time I only had like 3 other guys that were willing to join me on the deal. And so we therefore maxed out on how much we could put into the deal. I was putting majority of the funds, the other guys were very close friends of mine, and almost like as if they were doing me a favor than anything else. And, we lost that deal. But then after that is when, I started really, really looking into syndication route to understand it better.
Okay.
Yeah.
Yeah, so you kind of just went whole hog into the out of state, because I know that's a kind of a big kind of mystery for a lot of people, and they're kind of concerned about it, because at least it's something that we do is kind of a mix between like doing it yourself, because we like to partner with people like that are on our core team that are in that market, so they can, especially if it's a heavy rehab project, because you have a property management company, but you want to make sure that you want to manage the property management company and have that direct kind of contact there, because it just makes all the difference, especially some of our horror story experiences. So definitely
no doubt.
Yeah. And then I guess anybody have any questions so far? By the way, I know I have a few questions. I could just keep rattling off it. I don't want to be the only one talking. But,
I have a question. So Jackie, thanks for being on this call. Really nice chatting.
Absolutely.
I want to ask you about, do you still hold any single family, or if you do still hold any single family, would you recommend selling them and maybe changing to multi or different asset type?
Yes, I still own all my single families, and I have no plan of selling them anytime soon. And here's the reason why. The generational wealth. that's how I look at it. All my single families, is just me and my wife who own them, right? We can own it, and 30 years from now, hand it over to my son and my daughter, and they can run with it. The best thing is every year they keep growing in value. It's funny. Brokers always tell me, "Oh, this is the best time to sell. That's the best time to sell." But that's like literally every single year is the best time to sell, which means the property value keeps increasing. I mean, if I saw this pro 5 years ago, I would have been happy. But if I sell it right now, I would have been even more happy because the value would have increased. But again, the same applies. If I sell it 3 years from now, I would even be more happy because the value will continue increasing. As you know, this are in Idaho. Idaho is definitely a state, according to the federal government, one of the fastest growing states. So the value of the houses are forever increasing. My properties have definitely tripled down in their value. And in my opinion, if I need that money, all I need to do is just do a HELOC, right? I'm a great fan of HELOC. I've done HELOC on 2 of my properties. Just use a HELOC to pull that money out and use it on my investment or refinance the property. I like to give the analogy of sugarcane. I don't know if you guys have done farming, but in the world of farming, actually when you do sugarcane farming, the way it works is you plant the crop, right? You let it grow, and then you cut it, and then you grow again, and then you cut it, and you grow again, and then you cut it. So in other words, that's my goal. I don't want to sell the farm. I don't want to sell the sugarcane itself. I just want to cut it, let it grow, and then wait a few years, cut it, let it grow. And that's basically what I'll be doing on some of my single family. Just refinance them, pull the money out, and let it grow again. Because the moment you sell it, which means it's no longer going to grow again. And I just don't see any reason why somebody want to sell it. Because the moment you sell it, it stops growing. Yeah, you get good money, but what if you can get that money over and over and over again?
Yeah.
And the best part, somebody's paying the mortgage and all the expenses. That's my favorite part, right? Yeah, the entire time it's not like I'm negative every time I cut it. When I cut the sugarcane,
It's a little bit taller.
yeah, the rent is thin, but it's gonna grow again, right? And it's gonna become big again, and then all of a sudden you're back to getting full rent again, and then you pull the money out and just keep refinancing it out.
Hey, don't forget that's tax free.
Hey.
There you go. That's even
Tax-free
better, right?
sugarcane.
No?
Yeah.
Yes, the entire time. So all this money I'm using to invest on other assets that are generating me more money, and I'm not paying tax, Yes.
Yeah, it's a beautiful thing. Yeah, I think.
So if anybody has a single family, I would not recommend selling it unless you have other, personal reason to sell it. You might have a top tenant. Yeah, it's part of the game. I do have top tenants, and like anybody who want to get in the business, you got to know it's not a walk in the park, right? You got to expect that there'll always be those, tough moments and tough calls you have to make, but it's part of the game. Just expect it and know that's what it takes.
Yeah. And I guess on that note, Jack, like what's been, I won't say your biggest mistake / lesson, but maybe your most memorable lesson that you've had, because I'm sure it hasn't been a cakewalk with roses and rainbows everywhere in your 10 years and 5 years of multifamily. But what's been kind of more of a challenge that you've had since you've begun?
In the multi-family or single family?
Really either. Whatever stands out
Okay.
most to you.
Well, single family is, I've had to evict a tenant that cost me a lot of money, and I lost money when that tenant lived here. And I know some people would say oh, it's a lot of stress, don't do it. They get burnt out. But in my opinion, you gotta look at it in terms of long run. It's part of the risk, when there's always tenants are it's they're always nice before they sign the lease. Once they sign the lease, then all their colors come out and the true character come out.
Mm-hmm.
You just gotta know that's part of the game. You gotta bet on them, do as much due diligence on them as much as you can, and then just take a chance. At the end of the day, the tenant, for example, that I had to evict, had everything, good credit, everything, it was all good. But then, 1 year after they started renting from me, everything went down south, and it was never fun after that. As far as multifamily is concerned, which is kind of the purpose of this call, I've been burned both ways. I've been burned both ways as a sponsor and also as a limited partner. As a sponsor, my first deal fell apart. I lost money on. It was a property that had a chiller, and the chiller caught fire literally 2 weeks before we closed. And the seller decided to walk away. We went back and forth for like 2-3 months, and they decided to walk away. And their reasoning for walk away was because they figured out they were going to make more money by selling it to somebody else. Because when they sold it to us with an older chiller that needed to be replaced. But now their insurance was going to put a brand new chiller. And for that reason, they were going to make more profit. Indeed, they did. They ended up selling the property for $500,000 more than what they were selling it to us for. We lost money on that deal, but none of my investors lost money on the deal. It's part of risk you take as a general partner. If the deal goes south, you got to be willing to, and you got to be in a position to be able to, take the hit. In this case, me and my other partner, all the upfront costs, non-refundable costs like, syndication, due diligence, loan application fee, and all those stuff, we basically have to take the hit. But we refunded every single one of our investors all the money. They were whole. We made sure that we make them whole. And that's because, when you're a general partner, you want an investor to have that peace of mind that, you're in control. And if something goes wrong, you'll still be able to, keep your words and make sure that their money is safe.
Yeah.
As a limited partner, my first deal as a limited partner is currently under contract right now. And there's a good chance I'm going to lose money on that deal. This deal I invested in 2018. I've only had one distribution since 2018. I invested early 2018. So right now in 2021, I've only had one distribution. And this is in Texas, because everybody always talk about deals in Texas as being, everything in Texas is going great. But you gotta be careful. Live in Texas. Deals still go south in Texas, guaranteed. And this is definitely one of those. And I will be happy if I break even. But to me at this point, I've resolved and, made myself at peace with the fact that there's a good chance I'm going to lose money on that deal. So, which means, by the time it's sold and everything, the money we're going to get is going to be less than what I invested. And it's part of learning lesson. I learned a lot on that deal as a limited partner, and how to look at deals, how to vet on the sponsors, how to vet on the deal itself, and the sponsors' assumptions and projections, because that's basically what makes the difference. The sponsor's assumption and projection makes a big, big difference. The property that I'm involved with, I usually, large properties with, whereby you basically have good professional property management company. But if you're a little too crazy with your projection and everything, of course, you're not going to be able to deliver on that. And that's just what it is.
Yeah, I appreciate you sharing that. Yeah, because it seems like every deal that you get your hands on in multifamily is just going to turn to gold, but that's not necessarily always the case. You always gotta keep yourself sharp. Keep yourself abreast of the market, the conditions, the environment, especially in your case. I think that's really valuable. Thanks for sharing that.
What exactly happened on that deal? Was it new development?
No, it was not new development. It was an existing B class asset, B minus asset. So when we bought it, it was stabilized and everything. And so this is one of those things, when you look at a deal, when an investor pitches you a deal, you can look at the fine line. Looking at the fine line is extremely critical. One of the things you got to look at is, what if they can't achieve those projections that they're telling you? And in my opinion, you should make assumptions, you should make decision assuming those projections are not achievable. Because if the numbers can still work with those projections not being achievable, they know you got a deal. But if the numbers only work if those projections are achieved, then you know you're taking a lot of risk.
Mm-hmm.
And that's what we did on this deal. There was a lot of projection that the sponsor assumed. None of those, majority of those did not come to be possible. And therefore, you know, the deal has not been able to perform. Luckily, I'm very glad they've not had a capital call. So that's really good. You know, they've been able to stay away from capital call. And it helped a lot that the fact that, you know, they did not do that. But at least, you know, nonetheless, we're not making any money out of it, and we're going to walk away and not making any money out of it. I'll give you an example, and this is very key. You know, as a sponsor, I've also had deals. You know, it's not like all my deals are going well. I'm gonna have to be honest. You know, it's always a mixed bag, right? You know, because you know there's doing the assumption and the rubber meeting the road, right? And when the rubber meets the road, it is what it is. It's always those assumptions and how much wiggle room you give yourself. You know, I have a property, I'm going to be honest, that, you know, we had projections that, you know, we were going to be able to achieve certain projections. We have not been able to achieve those projections. We've only had one distribution on that asset. But we gave ourselves a lot of wiggle room, you know, in terms of, for example, assuming the exit. So that deal, I don't expect, you know, to be honest, to get much from the cash flow. But one thing I can assure you for sure is that we are still going to double investors' money, even though the entire holding period, we are not getting anything from the cash flow. But at the end of the day, when we sell the property, interest, the investors are still going to be able to double their money. And that's because you always make two assumptions, right? One is the cash flow assumption, and one is the exit assumption, right? You know, what are the exit capital using on that deal, right? You know, you don't want to go with what the market is. You always want to assume that when you sell the property, the market's not going to be on your side. Things are going to be really, really bad when you sell. So that, you know, when it comes time to sell, you know, it's not like all of a sudden you're hoping for the best and everything that doesn't work on your side. So in this deal, the cash flow has not been as what we had projected. So therefore, we're failing on the cash flow side. But from the equity side, in terms of exit, we had assumed way higher exit cap rate than what the market is. So we are still going to be able to double the investors' money, in this case, in 2 years, not 5 years. The underwriting is a 5-year underwriting. We're still going to be able to double investors' money in 2 years and make them whole and double their money in 2 years, even though during the holding period, they're probably going to get only one from the cash flow. And that's because, you know, we gave ourselves a lot of wiggle room from exit point of view. I know you had asked one question, but I kind of expanded, so hopefully.
No, that's yeah. I think the personal experiences add so much color to it. So, is there I mean, that sounds like a lot, but I mean, on the flip side, I would think there'd be like a major like positive lesson that you've learned on the flip side from your. Yes,
I've learned a lot. One thing, I'm not gonna go for, you know, right now. I gotta be honest with you. I'm not looking for C-class assets anymore. No offense to everybody who's looking for C-class. You know, people grow through the food chain. I've had my fair share of C-class assets. I'm not looking for those anymore. You know, if I can get the same returns with a B or an A, I'll go for it. You know, right now I'm getting more leads from the investors. I mean, not investors, but from the brokers. And so I'd rather focus on new assets, clean assets. Maybe slightly less return, but less risky. so to speak. This asset I'm just telling that we're struggling with is a true C class, but we gave ourselves a lot of wiggle room in terms of the assumption that we gave on the asset itself. We gave ourselves a lot of wiggle room in terms of cash flow, but like in this case, it just like, for example, we just spent $54,000 on plumbing, for crying out loud, over the last 2-3 months. I mean, how do you account for that on plumbing, for crying out loud? I mean, even if you assume everything, the property is stabilized. It's not like it's not stabilized. It's mid 90s, is cash flowing. We've more than doubled the cash flow since we bought it from the sellers. The rent have increased like over $200 above what it was when we took over, less than 2 years ago. So in terms of rent collection, it has been collecting rent and it has been stabilized, but it's just that this problem, that problem, literally yesterday there was the boiler broke, and now we had to spend $5,000 on a boiler. That's unplanned capex that all of a sudden now you have to pay for. Plumbing has been a major issue, and we keep just running into these other things that went beyond our control. It's not like a lot of you plan for capex, but again, there's certain capex that is part of the risk you don't foresee, right? And they just happen, like you buy the property and then it happened. The day we closed the property, the chiller broke down.
I remember you telling me about that. Yeah, in 2018. Yeah, that was,
it's not been a fun experience. I tell you for sure, it's not been a fun experience.
Yeah.
I mean, how can you? I remember the day you literally closed, like the chiller was just waiting for you to close, and then boom, there it is. Yeah. So. Yeah, and luckily with the chiller, we on our capex budget we had planned to replace it. So as soon as we took over, within a few months we replaced it. So it's never been an issue, but there's always been one thing leading to another, leading to another. So it's part of the risk, and and it's something I like to tell my passive investors. As I, grow in these industries, like, hey, it's part of the risk. You got to know that there's a lot of risk. We're going to give ourselves a lot of wiggle room. We're going to give ourselves a lot of room to grow. But it's like any other business, nothing's guaranteed. And you just have to, be ultra cautious. And as a passive investor, they have to vet and see exactly how are you mitigating those risks. Because at the end of the day, any passive investor who's doing who's doing their homework in terms of researching, they should know that they need to make a decision based on worst case scenario, not based on the best case scenario. Not even average scenario. They should make decision based assuming anything that the sponsor is telling them is not achievable. What if all those things the sponsor is talking about is not achievable? Can the numbers still work? And if the numbers can work, are they comfortable with that number that can work? And I think that's very critical.
Yeah, absolutely. Yeah. I think having that eye for just a slight degree of criticism in a healthy way really goes a long way. So
yes,
yeah, thanks for sharing that. I have one more question just from my end, but if anyone else, feel free to chime in. But because I see that you do a deal. It seems like every month, but maybe even more frequent. But I also know for people that don't know you also I think as of late before recently you had a full-time job as well, and I could never really understand how does Jack one sleep, and then two just kind of handle duplicating his mind into doing I think your day job, which is kind of not in the real estate industry per se, and then kind of having your whole world in this real estate. So how did you kind of manage that sort of full-time load effectively in both worlds kind of at you at one time?
Yeah. So just for the record, I quit my job mid-January, so about a month and a half ago.
Yeah.
It's funny. I just realized somebody mentioned it to me. I need to go update my LinkedIn so it doesn't show up anymore. But but the whole of last year and the years before that, I was doing both at the same time. It took a toll on me because I would always have those scenarios where you go to work in the morning, get back home like 6, 7 p.m. Spend 1 or 2 hours with the family, and then get back online, and that's when I'll be doing all the underwriting, and all the follow-up emails and everything, and go to bed at 1 a.m. Right now I have a little bit of more flexibility there for since then. Now that I don't have a W-2, so I definitely have a little more flexibility because this is what I do full time. It works best. I know a number of people are still doing it there. I would assume it's a sacrifice. Think of it like back in college days when you still had to work and go to college at the same time. There's a certain point in your life where you just have to sacrifice for the better future of you and your family. That's how I look at it. I remember back in my college days, at one time I had like 3 different jobs and going to college full time. So, by the time, you get off work at 5 p.m., you go straight to class, evening class. And after the class, you go to Starbucks. I went to college in LA. So there was a number of Starbucks that closed at midnight. So, here at 9 p.m., that's when you're heading to Starbucks to do your homework till like 12 midnight and then go home and then next day. So it's a little bit of a sacrifice, and I'm glad, I did it. And because at the end of the day, you got to sacrifice now so you can enjoy the future. And I'm glad it's basically paying off for me right now. One of my friends, asked me, so do you know your source of income? And I say, like, my biggest problem is trying to keep up with the paychecks that I get from different sources of income. And that's because of those, days of working hard,
Yeah, you put in the time.
Yes.
Yeah, I think that's a
I'll
true
stop the
quality.
time. There you go.
Yeah. That's the hallmark of the investor, being long-term minded and being willing to sacrifice. So that's all of my questions. I do want to have a short time to network, but we do have one question from the audience from Ranjit. Ranjit, feel free to ask your question live if you'd like. Otherwise, I can read it for you.
Yeah, can you guys hear me?
Yeah, loud and clear.
Hey, so regarding the single family investments, wouldn't the old houses have significant maintenance issues?
No. So I'm very lucky because, when I bought my houses, I moved to Idaho, Boise, that is, from Los Angeles. And, by the way, I highly recommend anybody who's living in California, no offense, James, but you need to move out. You need to come to Idaho or something, And time to forget about Seattle, man. Idaho is just across the border, man. Come enjoy life a little.
I think you just lost half of the audience, Jack.
I had 8 years in California. I'm now originally from California, but 8 years in California. And then I came to Idaho. And so I've seen both worlds. And I feel like, it's just before I answer that question. So when I came to Idaho, my boss that hired me was actually based in San Diego. But the job that I got was with HP in Boise, Idaho. And me and my wife, our plan was to move to Idaho, live in Idaho 3 months, and then request for a transfer back to California. Because we just couldn't imagine seeing ourselves living in Idaho that long. And I tell you, after 3 months, and then it opened up, it was a different story. We just fell in love with no, we're not going back. So I feel bad for anybody who thinks, things like me before then. I think you got to at least give it a try. Give it a try. Come live a month, see what it is like, and I would bet your eyes really opens up. Anyway, back to the original question. So when we moved to Idaho, for somebody moving from LA at that time, it's like buying house pennies from the dollar. That's how it felt like, my first single family investment, I bought it for 80,000, in 09, right? At that time, similar house in LA was going for about 250, 260, and it was about a 5-year-old house. It was not that old at all, And so it was like, Idaho had a major development boom leading up to the 08, 09 crisis. So a lot of houses that are there for both were pretty much all new. All of them were like less than 10 years old. So if you think about it, all my houses are in the 2000s built. I've not had a chance where I have to replace a roof. I've had a few cases where I have to replace a boiler, or an air conditioner, because those are 15-year, right, lifetime. But it's been really good. No major capex that I've done, but even if I've done right now, I've recovered all my money. As Robert Kiyosaki says, infinite money. Like, for example, that first house, my first investment, right? That house, when I bought it for about $80K. My mortgage was coming to about $500K, give or take. But the rent payment at that time was about $400. So I was basically $900. So I was basically getting about $400 profit from day one.
Wow.
About a year into it, I refinanced that house. I pulled all the money out of that house. So I don't have anything in that house left. It's infinite return. As if you've listened to Robert Kiyosaki, infinite return concept, and then I refinance it again and I pull out the money again. Back to that concept of, you keep cutting the sugar cane tree, let it grow and cut it and let it grow and cut it. And it just seems to be working for me like that. And if I were to replace roof in that profit right now, well, I've already pulled all my money out. So it's not like, it's costing me anything because, and the rent on it right now, my net profit per month is about $300, even though I've gotten all my money out of it. 300 to 400, give or take, somewhere there. Yeah.
Yeah, great question, Ranjit. Yeah, it's I think it definitely depends on the build of the house, and at least in our experience too. It's kind of whether the property's been renovated or not, because you can definitely have a 40-year-old house that hasn't been touched, has lead paint everywhere, and other issues. But you can definitely have a few major things like boilers that have been replaced recently and roofs that really kind of really upgrades the property.
Yeah.
So. Yeah, so age is it's a number for sure, like human age, but I think it really depends on what bones you have inside as well.
Yeah.
Yeah. So, but I know we're
regarding multifamily. So earlier, when we were discussing around what went wrong, you mentioned about all these unexpected capex expenses that came in for various properties. But otherwise, have you seen vacancy going up as a problem for any of the properties you've been a GP or LP?
No, not at all. It's funny. I'll give you an example. I'm not having any vacancy issues at all on all my properties. Because first of all, rule number one, get the right property management company to manage it for you, because then, it won't be an issue. Second thing, I only focus on landlord-friendly states, so it's easy to evict a tenant and get a new tenant and all that stuff, make it a lot easier. All my properties in the mid-90s. I give you an example. This is a perfect example. So the last property I closed in October, I'm closing one right now. We're supposed to actually be closing 2 weeks ago, but thanks to winter storm, now it's delayed. But the last closing closed before that was in October. The day we closed that property, it was 76% occupied. Let me take 2 steps back. So the day we signed contract, it was 80% occupied. It got worse. The day we closed, it was 76% occupied. Within a month of us taking over that property, we got it back to 90. Within a month, from 76 to 90%. And right now, that property is hovering in the mid-90s since we took over. Rule number one, get the right property management company that can, that knows the market and has the right resources to help you run the property. Because at the end of the day, it's the property manager that will make you kill the deal for you, right? At least, in my opinion, I only work on property, large property with the full-time resources and everything. And I'm, relying on the property management company to help me deliver and execute on my business plan. So vacancy is a key part of the thing that we talk every single week. All my properties, we have weekly call with the property manager and the regional manager. Vacancy, delinquency, is key part of the weekly discussion that we talk about. We talk about what we target, what we want to do, how many leases have been signed, how many leads have been received, and all those stuff. So very important that you talk about that with the property management company. It's not an issue for me because I'm right on top of it, and I have the right property management company to help me make sure that we keep the vacancy under control. Right now, the challenging thing is delinquency because, as you know, with everything. But again, you can always mitigate that with, first of all, having the right property management company, because the right property management company will always figure out a way to get rid of a tenant if a tenant is being tough, And as long as you have a landlord-friendly state like Texas, it's going to be easy to get rid of a tenant if they need to, because they just, there's no CDC moratorium and guideline, but, the CDC, this loophole enough that, you just have to, make sure you have somebody who knows the law, understands all the loopholes. And if you need to get rid of tenants who's giving you a hard time, there's different ways to do it.
Yeah, having professionals on your team is definitely can be a lifesaver, especially in your cases you mentioned third party management. That's heard that from almost every single successful really multifamily investor. So yeah, definitely agree with that there. Henry, what do you think? Do you think we'll have enough time to kind of just do a little networking?
Yeah, I think we should just go around, and since we don't have too many people, just introduce yourself, talk about what you're working on or what experience you have, or maybe anything you want to talk about. So why don't we just start off with, since I'm talking, I'll just quickly say hi. My name is Henry Yoon, and I'm in Seattle. Kind of doing this moonlight thing, working as an engineer during the day, and try drinking as much coffee to keep up with things. Working with my great partners here on this call, the M5 group. We're looking for deals and multifamily, and also on the side, I'm also looking to form a fund to also invest in other great sponsors and helping my investor to achieve the returns they're looking for. That's what I'm doing now.
Nice.
All right. Go next, James.
Yeah, I can go. James McCurry, based in California. But I've been in real estate for a few years, focusing mostly on commercial real estate now. Have a little bit of experience with passive investing in commercial and then a few single families as well. So a little bit of kind of everything, but focuses on multifamily now. We look mostly at kind of like you, Jack. We kind of mostly look at the higher B class property because we have some demographic criteria that we kind of really stick to because of some past experiences we've had with some lower kind of like C class properties and just kind of like a lot of horror stories I could probably make a whole webinar on. So, but that's kind of our focus and kind of like, I work with Chuck, so he's based in Florida. That's kind of like one of our stopping grounds. So yeah, but it's definitely a fun journey and really, really love just connecting with people. Like, just as a matter of fact, I met Jack, I think it was like 3 years ago, at least. When he was doing his first deal, when he was talking about the chillers. So it's just a really
I think one of the events in Dallas, right?
Yeah. I think, I forget one of them. There was always a ton, but yeah, it's just really neat to see this community and how you can really make develop friendships that last, several years. So that's me.
Nobody else?
You're it.
Yeah, all right, I'll go. Henry, I was in Seattle this weekend. I totally forgot to reach out to you. I know it was COVID, so people are kind of weird about stuff. But anyway, my name's Colm. I'm out of Sacramento. I actually have an opportunity in Sacramento if anybody's interested. It's a new development with a guy with 30 years of construction experience. It's ground up construction. We already own the land. So that's a big differentiator, right? We own the land. And then,
Nice.
so if anybody wants to talk to me, you can just look up my name per the, it says my name down there. Just hit me up on LinkedIn, or my number is 916-505-3592. I just wanted to learn a lot from Jack tonight. It was really interesting because he basically talked about how his process, even though there's cash flow struggles, his process in the selection side was validated because you still had the equity growth on the exit. So I really like that story. So thanks for sharing that.
Yeah, thanks. No worries.
Yeah, I just want to chime in. Colm, I agree with you. Listening to Jack was great hearing your story, and very happy for you. I mean,
Thank you.
Oh shoot! Hang on a second.
Heck yeah, Pat's here.
Let me. When someone else go right now. I'll be right back with you.
Sure. Anybody else want to? I see a few familiar faces on here, so.
I can introduce myself, Jeannie Allen. Hi, Colm. Colm, did you get your hair cut? Turn sideways. Oh, no, there it is.
Oh, there it is.
Googled me.
I'm donating it, so it's just getting a little long.
Good for you. Fabulous.
It's getting a little long.
So I know a few of you guys, just like Facebook and stuff. Colm and I have been in a lot of the Neil Bawa stuff together. And Chuck,
Nice.
I track you down in Florida and you wouldn't be tracked. So you found a different group of people to hang out with. So we are actually are in a deal right now. So some of you probably know it from our Facebook posting that we have under contract 60 units in Fort Worth, Texas, and we are looking for capital now, having our investment webinar next Thursday, a week from Thursday night. So if anybody would like to come to that webinar, please let me know and I'll send you an invitation. Colm, I've got your email. You know what? I'll put it in the chat, how to get a hold of it.
Yeah, that'd be great.
And it's it's a really sweet deal. It's Fort Worth, and sounds like a lot of you guys are pretty familiar with Texas, and Fort Worth is definitely, wow, this is our first deal, and what a place to land, put our feet down first. And though it's our first deal, we've partnered up with sponsors who have what do they have? I think they have 9 properties in Texas already. So we've got a lot of experience coming into the group. And we are just really excited about this. It is a C class that we're taking back to a B class. It's the newest property in this particular area of Fort Worth, but it's the least kept up. All the other, the 60, 70 properties have already been updated, and this 1984 property has not been updated. So we're going to be able to get it updated and get it back to where it should be the belle of the ball in its neighborhood. So it's about a $251 upside on each unit once we get the upgrades done. So it's creating a nice opportunity. One thing that stands out about this one is that we're doing a refinance. We're doing a bridge loan, and then we're doing a refinance at year 2. And Jack, you were talking about taking your money out as you get a property stabilized. And this has just been such a great learning experience to see how, especially in today's interest rates, we're only paying 4.5% on a bridge loan. And, a few years ago, bridge loans were crazy, stupid expensive. But at 4.5, you can think the numbers work. 2 years after we get it stabilized and get those units upgraded, we'll be able to give our investors back about 50% of their money. So they'll still have 100% of their ownership, but 50% back of their money, which means that you can redeploy that money into the next deal. And that starts working you towards that infinite return.
Yeah, halfway to infinity.
Halfway to infinity, exactly, and beyond. So I'll put my my contact information in the chat, and if you want to come to our webinar, it is accredited investors only, $50,000 minimum. So I will put it in the chat.
Yeah, Jean's super active. At least I see her everywhere. So yeah, it's been great to follow her progress over the last several months. So it's great. Thanks for sharing, Jean.
So are you having Neil Bauer partnering with you on that deal, Yin?
Our other two partner groups were three couples that have partnered together, and we all met through Neil Bawa training. Yeah.
Oh, okay. Okay.
I met Colm, and that's how I met Chuck. Yeah. So probably all of alumni.
Yeah.
Is that Neil Bauer book come? I've never attended it. I always wanted to come attend it one of these days. So
yeah,
hopefully,
no, he's
yeah,
a pretty amazing guy. Colm hangs out with
no
him all
doubt,
the time.
no doubt. Yeah, I've had a couple opportunities where we got close to joining forces, but we never worked together. I hope I can do a deal with him one of these days.
Yeah, who knows? Anybody else would like to share?
Well, my technical difficulty is over. So, yeah, I just want to
great.
hear Jack and his story. And thanks so much for sharing. It's very informative. A lot of good stuff there.
Yeah. Mm-hmm.
I'm a broker in California. I am interested in a couple of apartment complexes out here. Unfortunately, I invested with my brothers, which means I don't see any money off of them. I have a big interest in mobile home parks for some crazy reason. So my hot and heavy is looking for mobile home parks, and I'm very big into the due diligence process, coming up with mechanisms that allow me to analyze the points of interest around mobile home parks that would make them a success. That's some pretty sophisticated software where I can pull up all the points of interest around pretty much any point in the United States. So it'll give me the Walmart stores, the county seats, the universities, airports, what have you. So I can tell what the surrounding points of interest are that would support a residential complex.
Mm-hmm.
And the software also goes into city facts, I think it's the website, and pulls out all the pertinent information to a real estate transaction. So instead of, how you got to say, I think it's city facts or
City data.
City data. Thank you.
Yeah.
You go into city data and you've got to sort through all the stuff, where the radio stations are and how many there are, and the bridges were built in 1928 and such other great pieces. My software goes and just pulls out, leaves that there, and takes the stuff that really helps you make a decision as to whether it's a market you want to invest in. So that's kind of what I've been up to.
Nice.
Hopefully I'll find a mobile home park before too long.
Yeah.
Yeah. And there's been a lot of talk lately. There's been a lot of talk around mobile home park. Definitely, it's been one of those industry that definitely, if you can get a handle on it, great. And the supply is so low that there's just so much demand for it.
Well, they're not making any more of them, that's for sure, or very few of them.
Yes. Mm-hmm. Yeah. That will make it very attractive. The supply and demand, right? Less supply for sure. Mm-hmm.
Anybody else want to introduce themselves?
I can do it. I don't have so much of real estate investing story to tell, but I'm probably one of the newest in the group around multifamily. Otherwise, my full-time job, I'm a management consultant. I focus on mergers and acquisitions for corporates. Been with multifamily for the past, I would say, 5-6 months or so. Did one deal as LP, which is a 143 unit out of Houston. I'm in the process of evaluating my second one, which is a RV park out of Dallas, one of the suburbs of Dallas. Yes, Patrick, when you're talking about mobile home parks, I was quite curious about that. So I'm in the process right now. Great. Maybe I might look into Genies as well, as I have some funds to deploy right now. So looks lucrative to me. Let me see.
All right.
Anybody else want to introduce themselves? I know the remaining people have had their video off, so I'm not sure if they do or not, but feel free to. But if not, we'll probably, I know it's kind of late for some folks, not in California, but there's a plus there. But yeah,
This is
I
my
guess.
best. These are my best hours of the night, right, guys?
Yeah.
Right?
Oh yeah,
Jack?
Chuck, yeah, go ahead.
I talked to Jack about caffeine late at night, about 2 in the morning sometimes.
That's true. You're a night owl, man. I know you can go pretty late, till super late, you know?
Yeah, Chuck's a trooper. That's for sure.
Hey, thanks for being here, Jack. I appreciate it.
Yeah, yep. No worries, man. Whatever can do to advise and help, you know, I feel like this is one of those, you know, things whereby, you know, I'm a big fan of Rodcliffe, and Rodcliffe is known for giving in abundance without expecting. And I try to follow the same footsteps, you know, just, you know, whatever can do to help, you know, because, you know, when you give without expecting anything, it will always come back to you. So whatever can do to help anybody, advice, you know, I'm always available to talk about anything, anytime, with anybody.
Yeah, really appreciate
Yeah.
that, Jack. Yeah, it's
Mhm.
you know, hopefully everyone on the call and all of our paths will cross in some form or shape, you know, in the future. But I appreciate everyone coming on and participating and listening to Jack, and for Jack for coming on. But yeah, stay connected. We have a Facebook group where we, you know, we have about, I think Henry probably has the updated count. It's probably going north or just approaching 200 people. It's a Coast-to-Coast Real Estate Meetup on Facebook. So we share a lot of interesting things that we find. We also have our newsletter that we share a lot of economy and real estate focused updates. So a lot of, we just sent one out yesterday, lots of cool things that really, it's just really an exciting time to be in America, really. There's just so much going on all the time. But yeah, hopefully everyone became a little bit smarter today and a little bit more well-connected. So stay tuned for our next webinar. Haven't scheduled it yet, but we'll definitely be doing something exciting, and I look forward to seeing you all pretty soon.
Thanks, everyone. Nice meeting you.
James, thanks for putting it on, man.
Nice
Thank
to
you.
see you. Bye-bye.
Take care, everybody.
Thanks.
Stay safe.
Thank you so much.